those who followed Tuesday's class, and then I was requesting if it's possible on when will this be? The last week of October, we can have classes almost daily. This will help us to cover, because I have a lot to teach, but I have very limited time. So if you allow me, and if you avail yourself, we can do that on sorry, on the last week of October. Kindly adjust my voice. Is it too loud? Is it too choppy? I need to know before I start so you can hear me well. Perfect, thank you. So we said by the time we are done in this class, there are a few things you'll understand: how Forex works in the simplest way possible. You'll also recognize how smart money moves the market. You'll also be able to spot the AMD. This is what we are learning today, and 159 patterns. I've seen someone, I don't know whether I'll get your name, who did a trade today using the CLT model. Yeezy. I don't know whether you are here in this class. Yeezy. And part of what we are going to learn today is what our brother has done, and I'll show you how you can be able to spot such trades. You need to understand that the market is very complicated if you don't know why you are getting into the market. The market is complicated if you do not know why you are getting into the market. This is the setup. I don't know. Okay, you can't see this. Just a second. Let me share this. Present something else. Present this one. Okay, are you able to see my screen? Are you able to see the chart? This is the setup. Yeezy. If I pronounce your name the wrong way, you'll forgive me. This is the setup he sent, and this setup, these are some of the things we are going to learn. He got the move from an FVG, and you see I had already marked it, but the real move will come from here, but we will learn this. So this is just to let you know. Today we are going to look at the charts most of the time, but before we get here, let us look at what we are looking at today. Here we go. So first things first, what is smart money concept trading? Smart money smart money concept trading is generally not about a strategy. It is a concept. It's a thinking you have to come with in the market before you execute. And so the market is controlled, and I said this on Tuesday, by institutions. We have banks like JP Morgan. We have they are called market makers. These are the guys that dictate how the market will be. They dictate where the market moves and how the market moves. So these market makers, they move the price in patterns that trap retail traders and then take their money. So the market makers, what they do is that they want to take your money and then they move on the direction that you had predicted they will move in. That is why you see a lot of people say that I had done my analysis well, but the moment I executed the trade, the market came, took out my my stop loss, and then went to the direction that it was supposed to go. That is the work of the market makers. They know where you put your stop loss, and they will come for those stop losses, because that is what makes them make money in the market. So if we understand how smart money moves, we trade with them, not against them. So we trade with the market makers, not against the market makers. We don't chase the price, we follow the footprints of the big players. So smart money concept, in a very simple term, is understanding how the market makers move the market, and then we wait for them and we move with them. That is how easy this is. So what are the key concepts on SMC? Key concepts. So smart money is based on a few things, or it's based on a few concepts. Today, because I don't want to give you a lot of information that you'll forget, I'll give you a few, like 4. These are the main concepts in smart money concepts. These are the main ones. The main ones. When you follow these ones, be sure that you will not go wrong in trading. The first one is an order block. Order block. This is the first thing. So what is an order block? An order block is a price movement where the market makers start to either sell or to buy. So an order block, I'm just paraphrasing so that you understand, is a point where the smart money moves a price whether on a sell or a buy. So for example, if you look at this, I hope you can see this, you can see that there is a buy candle before a significant sell. There is a buy candle before a significant sell. Don't worry, I'll send you this PDF so that you can read all these things. It is because I know we don't have time today, that is why I'm moving a bit fast. So what happens when price moved or the price was moving downwards? It did something we call mitigation. What is happening here is mitigation. And where did it mitigate to? To the order block. The moment the price got to the order block, it continued to sell. That means this point is where the market makers got into the market. This is where they got into the market, such that when mitigation happened, immediately the price got to where the market makers moved the market started to sell. So let me show you in a real life situation in a chart. Let me show you an order block. So I don't know whether we will use this or let me see. Yeah, let us use GBP USD. And let us look for a sell. So assume you don't know what is happening on the right. So we look at this. Can you see this? Are you able to see? Can you see where my cursor is? Here. So If you look at this market, the market was buying here until it got to this point. When it got to this point, the market started to sell. It is sold a bit here, retraced, then sold again. So this area here, all this area, the last buy to sell candle, can you see it? Let me do. Can you see this candle here? This one. You can see this candle. When you see it, kindly give me a thumbs up so that I know we are together. This green candle here. Perfect. So this candle, this is where the market makers got into this market and they pushed the market down. So this is what we call an order block. It means even though you don't know what is happening on the right, once you draw this, and I'll tell you, and I'll show you how to spot an order block, or how you know that an order block is valid. Once you draw this, you know that when this market comes back to this area, the market will sell. Why? Because this is where the market makers made an entry into the market. So let us see what happened when the market got to that place. Can you see that? When the market got to that area, because when you draw, you don't draw with the wicks, you draw with, this is called yeah, perfect. Let us go back. What happened when the market got to that area? The moment the market got to that area, it just tapped and it started to sell. So that is what we call an order block. An order block is the area where the market makers or the market movers entered into the market. That is what we call an order block, where the market makers are entered into the market. We are also live on TikTok, so if you have a question, just drop it either on TikTok or on the chat. I will see it. Okay, so let us look for something else. Let us look for something else. For example, if you look at this here, let me show you. Okay, this sold from an FVG. I want to spot another block. Okay, let us look at this one here. The last sell before a significant buy. This is what some people call support and resistance, but this is not. I'll tell you the difference between support and resistance and what I am showing you. Look at this. This is an order block. This is where, because the market was selling. When it got here, it is spiked upwards and it broke structure here. I'll tell you what a break of market structure is. So this is an order block. That means when the market gets back to this place, we expect that the market will start to buy. So the market bought and then it came back. What happened when the market got to this place? It bought, and it bought like 225 pips. At least by now, when I say pips, you remember the last class we talked about, we know what pips are. It is the smallest movement in the market. So let us look for another example. Look at this one here. The market was in an uptrend, and then there was a bit of a raging market here, and then when it got to this area, the market just spiked up. So the market spiked up. When it came back, this is called mitigation. When it came back to that area, to the order block area, what happened? The market started to buy, and it bought like all this is from that move, like 214 pips. So an order block is an area where the market makers entered the market. So when the market revisits that area, you expect that the market will react from that area. Wow, what time is moving very fast. We've just done one. Okay. Okay, someone is not seeing my screen. Who else is not seeing my screen? Veronica, try to leave the meeting and then join again. Try to leave and join again. I'm sure you'll be able to see my screen. I'll try to. Are you following with the phone or with the laptop? I'll try to zoom it out so that all of us can see. Okay, I'll try to zoom it out so that we all can see what is happening. Sometimes with a phone, I don't know, but I am recording this. It will be on YouTube so that you can be able to see it clearly. Yeah, because the phone screen is a bit smaller. Okay, there are 3 things that an order block must answer. 3 things. An order block must answer 3 things. 3 things. Number 1, the date break structure. If you look at this, so I'll be forced to zoom this in so that we all can see. If you look at this order block here, you'll find that it broke structure here. Breaking structure means it broke the last swing low here. Okay, so an order block must break structure. That is the first thing. Okay, let me try to show in the charts. I'll try to zoom it out so that we can see. Okay, where are we? Where is this? So you are telling me that you cannot see this. Okay, let me try to zoom it out. I think this is the best I can do. Yeah, I think with that now we can see. So we are saying an order block must answer 3 questions. Number 1, the date break structure. If you look at this, this is what the market was doing, coming up, down, up, down, up, down, up. When it got to this place, it did not create a higher high here, so it is sold from here and it broke structure. This is what we call break of market structure. Don't worry, I'll send you this PDF so that you'll be able to understand. This is what we call BOS, break of market structure. So an order block must break the market structure must. If the market structure has not been broken, you cannot call that an order block. Okay. Second thing, an order block must have a fair value gap. That is what we are learning next, so don't worry if you do not understand what a fair value gap is. That is what we call a fair value gap. So the market, two things we've seen. Number one, the market must first break the market structure. Number one. Number two, it must have a fair value gap. Number three, it must take out liquidity. So someone was asking me yesterday, what is liquidity? Liquidity are the swing highs and the swing lows. So if you look at this, it took out this liquidity. Okay, I hope I'm not going fast. I'm trying as much as I can to, because of time. I don't want to keep you here. So this is the last swing high. So what happened is that the last swing high, which is liquidity, was taken out, and then the market came down, retraced, and then broke structure. Okay, it broke structure over here. These things are not difficult. By the time you get to 2 weeks, ninyi ndio mtakuwa mnanifunza hizi vitu. It broke structure here. So three things have been answered here. Number one, the liquidity was taken out. This one. This is what we're calling liquidity. Liquidity was taken out. Number two, the market structure was broken. The market structure was broken here. That is number two. Number three, there is fair value gap, FVG. And fair value gap, we are looking at that in a few. This is the imbalance, because this is what happens. A market where the market have sold, it has to buy. You see, something like that. So that's an up trade, or we can have a down trade. Like that. But you see, in this case, in case of an order block, and this is the main difference between an order block and support and resistance. This is the major difference. So with an order block, you see, when the market makers came, the market moved crazily down. So the market did not have time to balance the buys and the sells. And in every market, buys and sells must be balanced. So you know an order block, you know the market makers were in a place when you see FVG. Okay, perfect. So we have answered the three questions that an order block must answer. Number one, did it have did it break structure? That is the first thing. Number two, did the market or did it I'm looking for that thing. Here we go. Did it break structure? That is the first thing. Number two, does it have an FVG? Tick. Number three, did it swipe the liquidity? I repeat, the FVG. Okay, I think we need to go to the FVG before we come to the breaker block. So what is an FVG? Fair value gap is a unique trading concept that occurs when the market moves quickly from one price level to another, often leaving gaps on price charts. Okay, So if you look at this, I hope you can see my small screenshot here. When the market got here, because now this is an order block, you see this one, this is an order block. When the market got here, it left gaps in prices. Or let me show in the live market. I think the live market will be easier for us to understand. Okay, so we can look for something completely new. For example, let us look at this one. Can you see this? I'm sure by now, yeah, I think you can see this. This is what I'm talking about. That is what I am talking about. Now, if you look at what is happening, let's say here, you see that there is something like that is happening. Okay, let me delete that. The market is moving from down, up, down, up, down, up, down, up, something like that. So this is what we call sufficient trading. Sufficient trading is when the market is making a series of higher highs, higher lows, higher highs, higher lows. But when you look at this, you see something. You see that what happened is that immediately this candle, tutasoma about candles maybe the last week or thereabout. After this, you see that the market is not giving us higher highs and higher lows. The market just moved at once. So it left a gap between the last price action and the last price action. This gap here is what we call FVG, or imbalance. So I hope now that is well understood. An imbalance is the gap in the market such that we don't have balanced price movements. Perfect, you've understood that. So that is what we call FVG. So for example, if you look at this is an order block. When you nataka ku trade kesho, I give you a very nice order block here. This is an order block. Why? Two things. It first took out liquidity. This one, you see this long wick here, it took out liquidity. Number two, it has FVG. All this is FVG. I'm actually waiting for this trade to materialize. This is FVG, or imbalance. Number three, it broke structure here. Actually, this was the last swing low. It broke structure. So it has answered all our questions, the three questions about order blocks. It took out liquidity, it has FVG, and it broke structure. I'm sure that is perfectly understood. So we go to the next thing, which is a breaker block. Now, so that I don't confuse you between an order block and a breaker block. A breaker block is an order block that has failed. A breaker block is an order block that has failed. Okay? For example, For example, let us look at a breaker block here. Okay, what is happening? Go back here. Good. I'm sure now you can see my screen. Perfect. So if you look at this, let me remove everything here. If you look at this, can you see this? This one is an order block. Why? Immediately the market makers got there, you can see that there was a break of market structure over here. Number two, you can see that the last swing high, this one, was taken out. Can you see that? The last swing high was taken out by this week. And then you can see that there is a lot of fair value gaps here. There is this one, and there is this one. Can you see that? There is this and there is this. Now we expected that when the market retraces to this level, it is sells. Okay, that is our expectation, because that is a valid order block. But what happened when the market got here? It is sold a bit. This was like 41 pips, and then this was like a raging market. Okay, let me explain this. There are three things that happen in the market. One, the market is either raging, you see this, or the market is moving in an uptrend, or the market is moving in a downtrend. The market can only do one of these things. Okay, so every time you open the charts, don't be confused. The first thing you ask yourself, is the market, this is what we call, we are going to learn this today if time permits. This is what we call I'm looking for this thing. Accumulation. You see that one? Then the market can do something we call manipulation. So we will just assume that this is for now, just for understanding purposes. And then we have what we call distribution. So every time you enter the market, it is doing either of these three things. One, it is accumulating. Two, it is manipulating. Or three, it is distributing. Accumulation, manipulation, distribution. Okay, right? So let's go back to where we were, so that because of time. So if you look at this, we expected that the market, when the market gets here, it will tap into another block and then continue to sell. But what happened? When the market got here, it started to rage. All this is a raging market. it doesn't have a clear direction. And every time you see this, don't trade. Live as if you umefukuzwa. Every time you see this, don't trade. Only trade if the market is distributing or manipulating, if you understand the market. So when the market got here, it reached, and then instead of selling, it bought. And you see, it bought like this was how many pips? 92 pips. So this is no longer not a block, it is now a breaker block. I hope you understand that. This is no longer another block, it is now a breaker block. Okay, another good example. Look at what was happening here. Can you see this here? If you look at this, this was such a mighty move upwards. And what happened is the market took out this liquidity first. You see? The market took out that liquidity first. So, and then what happened? There is an FVG here. By now, hizi vitu mtakuwa mnasema vizuri sana. This is FVG. Every time you see a gap in the market, it's an FVG. You don't have to think about it. So, we expected something. We expected, because this is another block, when the market moves up, once it comes down, we expected the market to continue buying. But what happened? When the market got here, it broke structure there. So this is no longer an order block, it is now a breaker block. And what will happen is that, let me take you to the lower time frame. When the market gets here, because now this has become resistance, so when the market comes, it will do its things, when it gets to the breaker block, it will start to sell. So this is 4 hour. Let me take you to 15 minutes. So can you see the resistance that is happening here? It is because of this breaker block. So okay, I don't know, I don't want to confuse you. Two things happen in the market. The market will either do something we call react from the breaker block, and from something we call a stop hunt, but we'll look at that later. It's not now. So what I'm expecting is this market will sell a bit, and then it will buy to somewhere around here, and then it will do the real move. That is what will happen. So this small buy can hold up to somewhere here, and then it continues to buy. Okay. Wow, time is moving. Okay, so let's get back to our presentation. Once we are done with this, and I'll open the door for premium classes, you will understand these things better. But even right now, I'm going to send you the PDF so that you'll not be lost. So what is the next thing we are looking at? Break of market structure. I've already shown you what a break of market structure is. A break of market structure is a concept that focuses on identifying shifts in the market overall trend. A break of structure is said to have taken place when the price sets a new high or a new low while breaking the former ones. So that when I go to the chart, I'll be fast. Let us also look at the change of character, because they look like the same. Change of character and break of market structure. A change of character refers to a situation where the market's behavior shifts abruptly. It is sudden change in volatility, volume, or price action, suggesting a weakness in the current trade and a possible reversal. I know that's a lot of English, but when you see it, you'll be able to understand where we are coming from. So, what do we do? Let me remove all this. And go back to 4 hours. I hope my internet will not disappoint me. Okay. Where are we? All right. I still have some internet. Are you able to see my screen? Good. So we are looking at two things: BOS, or break of market structure, and change of character. Okay. All right. So I want you to look at this. I want you to look at. Let me just start here. Let me start here. So if you look at this, you can see that this is a clear uptrend. The market is making a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher high, higher low, higher high, higher low, higher high, higher low, because this low must take out the previous one, and this is happening until we got here when we made a higher high. Can you see this? Oh boy. Okay, sorry, let me restart that. We can even start from here. This is an uptrend. Higher low, higher high, higher low, higher high, higher low, higher high, higher low, but we never made a higher high. Can you see that? We did not go past this. So what happened? The market changed from now making a higher high to making a lower low, lower high, lower low, which is here, and now we are expecting this to make a lower high, lower low. So look at this. From this is what we call a break of market structure, a BOS. Okay, because the market, this move broke the previous high. This is also a BOS, because this move broke the previous high. But I want you to look at this. Let me make sure I'm seeing it perfect. I want you to look at this. Here, the market did not break this high. What it did, the market broke the previous low, that low. So this is what we call a what? A church. Change of character. So kama umeelewa niambie tafadhali. Give me a thumbs up if you have understood. Good. We are understanding these things. So a break of market structure is if the market is either in an uptrend or a downtrend, and then it breaks the previous high or the previous low. But a change of character is when the market takes out the previous low or the previous high. That means this tells you that right now we are in a downtrend. Right now we are in a downtrend. Why? Because the previous low was taken out. So we are no longer now in a uptrend. We are now in a downtrend because the previous low was taken out. Okay, that means this one, these are what we call, this is a strong high. That is a strong high. Strong high. Why? Because this is the high that broke or changed the character or broke the market structure to the downward. So wale swing traders, if you could have taken this trade from here na uweke nini yako hapo and then you target at this liquidity here. Hii ni ya swing traders peke yake, hawezi tolewa hata utarget hii. Hautatolewa, but we are not there yet. So that is the difference between a change of a break of market structure and change of character. Change of character. Change of character. Okay. I don't know what is happening here. So I want to take you back to present something else. All right, here we are. Here we go. So those are the two differences between BOS and change of character. Okay, this is another question that a lot of people were asking me. What is liquidity? What is liquidity? Liquidity is a crucial factor in SMC trading. It is a point in the price of an asset where orders are either sitting above or below, waiting to be collected. There are different types of liquidity. There is trade line liquidity, buy side liquidity, sell side liquidity, double tops, double bottoms, etc. So let me show you part of what liquidity is. Liquidity in the live market now. Okay, this is Euro USD. Let us try GBP USD and see what we have here. So every time you see something like this, this is the green candle, like that, and then it has wicks, either a wick above and a wick below. and then you see that there is a candle here. It doesn't matter the color, it can be red, and another one here. So this can be having wicks. I'm just trying to move fast so that we don't waste time. This high is liquidity. That high is liquidity. So let us look at real life examples. So let's say you are, let me start with what we call trend line liquidity. If you look at this, the market was going up and then the market started to drop, making a series of, hii ndio inaitangwa internal range liquidity. Now what happens, siji kama kuna mtu hapa trade lines, just show me with maybe a thumbs up or something. Trade lines, if you trade lines, oh my god, hakuna trader wa trade lines huku. Ndio huyo Mr. John Degwa. So this is what happens. This is what happens na trade line liquidity. What happens, the market was moving up and then it started moving down slowly, making a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. All this, you see, all this is liquidity. All this is liquidity. Why is it liquidity? Because hapa kuna vitu zinaitangwa buy stops. Unaona huku? Buy stops. Buy stops. Buy stops. So what they are doing, or what the trade line traders are doing, wanaeka buy stops hapa such that, no, wanaeka sell stops such that when the market comes to or breaks above this place, okay, if the market breaks above, their orders will be activated and they will be looking for buys. Okay, where is the stop loss? The stop loss ya hii nini, hii whatever iko hapa itakuwa for example wataweka something like this. And where are they targeting? Maybe the previous high, like that. Okay, so what is happening is that there is a lot of liquidity here. There is a lot of liquidity here, and the market needs to activate this and then reverse on them. It needs to activate their orders, the buy stop orders. Angalia hapa. If you look at this, the market activates the orders. Every order that is here, all these swing highs and orders resting there. So the market needs to activate, and then ita move kidogo ndio waone kama wako in profits. They move like 24 pips. Ndio waone yeye yenyewe nini yetu inawaka. And then very fast the market will move down. The reason it is moving down, it is moving down to take all the stop losses zenye walikuwa wameweka. So liquidity ni a hunt for stop losses. Unasikia tunasema every time you enter a trade, make sure umeweka a stop loss. The reason we are saying that Sell stops, sorry, mampesh. Sell stops. So the reason we say that, it's not so that market makers wakuja wachukue nini zako. Okay, let me see what is happening kwa TikTok. So all this is trade line liquidity. Trade line liquidity. All of that. Number 2, these swing highs and swing lows. For example, let's see an example here. Let us look for a market that is okay. This is good. This is good. So if you look at this, we were moving in an up trade, and then there was a bit of a raging market here, and then the market changed now to a down trade, and we are making a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. Now all these swing highs and swing lows, you see this, all these swing highs and swing lows, this is liquidity, and this liquidity must and will be taken out. This liquidity will be taken out. And so every time you enter into the market, what are you looking at? Especially kuna mtu uliza, nikiingia trade nitaweka wapi my take profit? Kuna mtu uliza hivyo. Let's see, for example, let's say we want to enter this, whatever that is happening here. Alafu tuchukue na hii FVG. You see this one? So we want to take a trade with this FVG. So you enter a long position, your stop loss maybe below the FVG. So the question mtu uliza ni, where do I place my take profit? Where do I place my take profit? You see, this was hii market ilikuwa inaenda chini. This was a market that was selling. So every ka swing high unaona ka buy, this is liquidity. This is liquidity. Can you see that? So that means if I was taking this trade, the first TP nitaeka up. I know that this will be taken out, and then I think it's early for me to tell you this, but it's just good because kuna experienced traders huku, they learn something. If the market breaks structure kama hapa, you see it broke structure here, you can see this. If the market breaks structure, retraces, then breaks structure again, this retracement here is always liquidity, and it will be taken out. Never forget that in your trading journey. If the market breaks structure, retraces, then breaks structure again, the high that has been created is always liquidity, and that liquidity will and must be taken out. So that is why if I take this trade, actually this trade I'm waiting for a confirmation, I enter this trade. I'm actually waiting for a confirmation. Hii nitapanda nayo hadi huko. The risk to reward ratio is 5. And actually, I'll show you as we continue that there is a way you can refine this to this breaker block here. You see this? So that means you will have a 4 pips stop loss and risk to reward imepanda hadi 16. But that is not for today, pole. You see, I don't want to confuse you. So this is liquidity. That is how you can you identify liquidity. The other thing, everywhere you see an imbalance must be taken out, whether soon or later. So every FVG you are saying it will be filled 100%. That means that FVG is part of liquidity. So you see what is happening here. For example, hivi ndio market makers huwa wanafanya. If you look at this, the moment market imetap this liquidity, imeanza kusell, and it can sell up to somewhere. So inaweza kuja iretest tena, ikuje hadi kwa hii nini. What will happen? Hapa watu wengi wameenta hii sell. I want to show you because SMC is thinking like the market makers. SMC. So a lot of people, maybe they are waiting for this retest. They enter the market there, and then wataeka nini yao wapi stop loss, maybe hapo juu ya FVG. Where will they target? The swing low. Okay, that is where they will target. So right now kwenye wako wanapiga makofi, wanasema wa tushapata trade. So what will happen is that this market might retest to this FVG, and then itakuja ikitengeneza liquidity. Once it gets to the breaker block there, it will come na ipite nini. So what has happened? All the liquidity that was here has been taken out. Stop loss their hour has been taken out. That is how market makers think, and that is why I don't know about others, but for me, I don't advise you to take trades using FVG, because FVG must be filled 100% unless it is higher time frame FVG. Kama hii, this is 4 hours. Ukiangalia hii trade, well, hii imechukuliwa na hii nini, but let me see kwenye trade ilichukuliwa na FVG so that I show you. For example, can you see this? This is FVG. Let me zoom it ndio uone. Are you able to spot that FVG? Good, you can spot it. So this move happened using this FVG. What has been created here, never forget, this is liquidity. You see that? That is liquidity, this one. So a lot of people washawekelea nini zao hapa, and then what were they targeting? They were targeting this high. In trading, you have to think like the banks. That is the high they were targeting. Okay? The moment waliingia trade na FVG, and it worked because hapa kuna mtu alikula. This is how many pips? Close to 150 pips. So this is the high they are targeting. So they are expecting the market will come and take this high. But what did the market do? It came, retraced, and then took out their stop loss, and it came and bought from this breaker block here. Can you see that? This thing, I'm telling you, once you understand this, you will be a magician in the market. Magician. Look at that. Na hii ndio bado tunaitanga hii ndio bado tunaitanga stop hunt level. SH stop hunt. So hii ndio ilikuwa itupatie the real move. And if you look at this, I want to show you. If you look at this, this is the move that took out the previous high. My God, are you able to see this? If you can see what I'm saying, give me a thumbs up. Good. Good, I can see we are getting. I told you today, please just add me like how many minutes? Allow me to finish at around a quarter to 10. If I will not be able to finish this, we can do it maybe next time. You will tell me. Mkiona kama tunachelewa mniambie. I can finish the class. Good. So the real move is the move that took out the previous high. Hii ilikuwa inducement ama, this is what we call inducement ama liquidity. See that? That is inducement. So the market makers are inducing people. Wanawaambia ingieni trade sasa, tunaenda, tunasonga. We are moving up now. It is time to move up. So a lot of people enter the trade at that point only for them to be removed later. And then hapa ndio watu usema my stop loss was taken or my stop loss iliguzwa, and then the market went to the direction which I had projected. Don't worry, that is what happens. That is what happens. That is what happens. You don't need to worry. So as for us, we are trading like the market makers. The market makers. I'm not sure we'll be able to finish what I had prepared for today, but let me see how far we'll get. When we get to quarter to 10, we will continue next week, or you'll tell me whether it will be available tomorrow. We can do an hour, 1 hour session. 1 hour session. Okay, so I hope now we have understood liquidity. This is trade line liquidity, double bottom. So when you see something like this, you must know that it will be taken out. Double top, it will be taken out. Okay, how to trade with smart money concept trading. How to trade with smart money concept trading. Number 1, determine the trade. Determine the trade. Are we in an up trade? Are we in a down trade? Or are we raging? This is the most important thing. Are we in an up trade? Are we in a down trade? Or are we raging? If we are raging, wait for the market to tell you where we are moving to. If we are raging. If we are in an up trade, wait for the market to give you a signal. If we are in a down trade, wait for a market to give you a signal. Okay, so that is very important. Understand where we are moving. If you look at this, my chart here, you can see that we were on a down trade until this happened. If you look at this, the market took the last swing high. So we changed from a down trade to an up trade. Okay, can you look at this? The chart above shows that the trade has changed from bearish to bullish after the change of character. This means that we are no longer looking to sell this pair. Instead, we want to buy when our entry criteria appear on the chart. Very important. Very important. Let me give you an example with the live market. I know we have a few minutes, and I'm not planning to take long. So look at this. This was a clear uptrend. This is 4 hours, yes. I hope you can see this. This was a clear uptrend until we got here. When we got here, the market did not create a new high. Instead, it changed character. And now we are on a downtrend. So we are expecting some, because the previous low has been taken out. So what are we looking at? We are looking at selling. We are looking for sales. This is GBP USD. We are looking for sales. Why? The previous low was taken out. The previous low was taken out. So what we do right now, we know that this one, you see this, that is liquidity. That one is liquidity. So for me, what I'll be looking at is when the market gets here, I will sell. But before that, we know that the market must, for this market to take out this low, that move must come from here. Must. So ukifanya trade yako sahi and then you put your stop loss there, you will never be stopped out until the market gets there. But I cannot advise you to do that, because you cannot risk 100 pips. That is inconsiderate trading. So understand first where the market is going. Understand the trade. Let me go back so that we move fast. So understand the trade. Number 2, identify high probability order block. For example, in my chart here, you can see that there is a lot of liquidity down here and there is a fair value gap. What will happen if this is high time frame? When the market takes liquidity and comes to the fair value gap, you expect that the market will start to buy. But the main move is here. This is the order block where we have the BOS. This is the order block here. So identify high probability order block. This is what I will teach people who will move on to the premium class, because it is very complex. You see that this is what I've just shown you here, that the order block we have is this one. Okay, this is my advice. I know you have traders here who trade fair value gap, but my advice is don't trade fair value gap, because FVG must be filled 100%. It will be filled 100%. It has to happen, and it will happen. So the best thing is to wait for the market to get to an order block, and then take a trade from there. It can take time, but waiting, patience in trading is everything. How do you determine your entry and exit points? If you get a clear order block and do your entry at a retest, the next place you should target is the last swing high. So, but this is a bit complex, and this is something we can learn later. Wiki ya mwisho tutakuwa na a lot of work to do, because we will be taking trades with you, live trades with you. So that is where you determine your entry and your exit points. So because of time, I will not go into this, because we will need a lot of time to look at this. This is the CRT. I saw someone who was trading CRT. I want to connect CRT with SMC and show you a very easy trading model. How long is this? Okay, if you want me to continue with this, nionyeshe, nimebakisha kama 5 slides. Thumbs up if you want us to continue with this, or we can do this maybe another day. Perfect. I think we have quorum, but I will move fast so that I do this in 20 minutes. So I use a very simple trick to do my trades every day. As simple as 1, 2, 3. Whoa, no good. Do you want us to go for a break? I've seen someone, let me see. Kuna mtu amesema tumesema vitu mingi sana. Okay. What we do, I look for time tomorrow. What time are you available tomorrow? Because I don't know whether I'll be available in the evening. We can do tomorrow. Okay, let's see whether if we get time tomorrow it will be okay. If we don't get time tomorrow, we can do during the weekend. During the weekend, what wako home, we can even do it during the day, because this is another very crazy thing. And at least so that I give you time to internalize what we've learned. But I will share the PDF once we are done with all this, so you'll forgive me. But what I'll do, I'm going to upload this class kwa YouTube, so you can go back and look at it slowly by slowly. Good. So in the group, kindly you will tell me the day that you will be available between today and Saturday, and the time, so that I also see whether I'll have my time on that day. So we don't have time for questions, pole, but you can text me the questions kwa group. I'll see whether I'll be able to answer them. And let's call it a day today. Go and practice on what you've learned. Go back to the video and follow it slowly. I know I've taught a lot of things, but it is because we don't have time, and this is a free class, and I need to give you as much information as possible that will help you. But be sure that I have simplified this. What I was taught by my mentor, if I teach you kichwa itaruka, it's a lot of information. So nimetoa a lot of information to make sure that we all understand, and we will get somewhere. So from me, that is it for today. See you either tomorrow or Saturday.